Picture two cars heading toward each other on the same road. One car is Canada's domestic economy slowing down with 0.6% GDP drop and 6.7% unemployment. The other car is global oil prices accelerating because of Middle East geopolitical tension. And that's not just a gas pump problem. It's a supply chain risk that bleeds into the cost of almost everything Canadians buy. The Bank of Canada is sitting at the intersection watching both, and on April 29th they have to decide whether to move or hold still. I'm going to show you why holding still at 2.25 is an indecision. It's the only move that avoids getting hit by both cars. Hi, Kane again. I'm a theatre grad that started with nothing. 20 years later, I own properties throughout Ontario. Be sure to watch my biography video on how I struggled. Read the description to see the references on where I've pulled this information from. If there are any discrepancies, let me know. This video is for educational purposes only. Speak to a professional prior to making any investment decisions. Without further ado, let's get started. Most people hear hold and think the Bank of Canada blinked, but holding at 2.25% when your economy is contracting and oil is climbing at the same rate time is actually the harder call to make, not the easier one. Cutting rates when growth slows is easy, obvious move. Staying put when two opposite forces are both pulling hard at the same time takes a lot of nerve. So, let's take a look at what the domestic economy actually looks like right now. GDP dropped 0.6% at Q4 2025, and a quarter before that it grew 2.4%. So that's not a slow fade, it's a sharp reversal on a single quarter. Unemployment climbed 6.7% in February of 2026, and the employment gains Canada picked up in late 2025 got largely erased in just the first 2 months of 2026. That's a fast deterioration, not a gradual one. Normally, those two numbers together, a contracting GDP and a rise in unemployment, are exactly what gets the bank cutting rates. Lower rates means cheaper borrowing costs for businesses and homeowners, and cheaper borrowing means more spending, more hiring, and the economy starts moving again. That's the standard playbook, and there's a reason it's standard, because it usually works. So why isn't the Bank of Canada running that play right now? Because headline inflation dropped to 1.8% in February 2026, partly because of a base year effect after the GST and HST break ended, and core measures set around 2%. The bank technically had room to cut if it wanted to, but oil prices moved in the opposite direction at the same time. This isn't just a general energy spike. The conflict in the Middle East is threatening the Strait of Hormuz, which is the bottleneck that moves not just oil, but also fertilizer and a wide range of global trade. If that strait closes or gets disrupted for any stretch of time, the cost of moving goods around the world goes up fast, and that feeds into Canadian prices well beyond what you see at the gas pumps. So you've got domestic data screaming cut, and energy prices screaming wait, both at the same time. Energy costs work differently than most other inflation outputs, and that difference matters a lot here. When oil gets expensive, it bleeds into trucking costs because diesel is more expensive, then into food distribution because trucks move groceries, then into manufacturing inputs because factories use energy, then into heating bills for every household in the country. A spike in oil prices can push headline inflation back above the bank's 2% target within a few months, even if wages stay flat and consumer spending doesn't budge. So, the bank is looking at a situation where cutting rates now would stimulate spending right as energy costs are already pushing prices up. And those two forces together could send inflation back above 2% fast, which would then force the bank to hike rates later to cool things down again. Cutting and then hiking in a short window is a much worse outcome than just waiting, because each move takes months to work through the economy and you end up chasing your own tail. Worth noting, the bank actually removed the line from its previous statement saying the current rate remains appropriate, which is a signal that they've shifted to a reactive, wait-and-see stance rather than a confident hold. They're not saying it's 2.25 is right, they're saying they won't move until one side of this breaks. Bond markets priced a low chance of a cut going into April 29th. So the market isn't just betting on the hold, it's genuinely split on which direction the next move goes. That's indecision. That's what a real standoff looks like when the data is pulling both ways. The CD, Howe Institute Monetary Policy Council, recommends holding at 2.25 all the way through March 2027, and RBC's forecast also expects no change through the year end 2026. So this isn't just the bank being cautious on its own. It's a broadly shared read across independent analysts who are looking at the same numbers. There's also an interesting irony sitting underneath all of this for anyone with a mortgage renewal coming up. A lot of people renewing in 2026 are finding that their new rates are actually very close to stress test rates they originally qualified a few years ago. So the payment shock many expected hasn't materialized the way people feared. That doesn't mean renewals are painless, but it does mean the floor isn't as far down as the headline suggests. The bank's March 18th statement said it would respond as outlook evolves, which means they're watching whether the GDP weakness deepens faster than expected or whether oil prices cool off first. And whichever one breaks first determines the next move. A cooling housing market, one the CD House report specifically flags as showing weak sales and falling prices, doesn't automatically trigger a rate cut because the bank isn't just managing housing. It's managing the gap between a slowing domestic economy and energy price spike that could restart inflation, and cutting into the gap before one side revolves is how you end up with stagflation. That's the one outcome the bank obviously cannot afford, and it's also the reason the next oil price report on the next job numbers matter more than whatever the bank says on April 29th. April 29th is almost certainly a hold, but don't watch the rate itself after the announcement. Watch the next oil price report and the next jobs number, because those data points are what actually triggers the Bank of Canada's next move in the second half of 2026. If your mortgage renewal is coming up, don't wait for the bank to move before you run the numbers. Fixed rates move with Government of Canada bond yields daily, so lenders adjust before the bank announces anything officially. Model your payment scenarios now. About 33% of Canadian mortgage holders will face higher payments by the end of 2026, with an average increase of about 20%. If you're on a variable rate, the range is wider, roughly 10%. For variable rate holders could see payments jump 40%, but about 25% could actually see payments drop around 7%. If you've enjoyed this, be sure to watch my next video on how the rich structures their entities so that you can prevent yourself from getting sued personally. Thanks for watching.